and 18,253 is where the index finds itself at. Our alpha manager today is George Heber Joseph. He's CEO and CIO at ITI Mutual Fund. George, great to have you here. Thanks very much for your time. So finally, a little bit of pullback. I guess a lot of positions, I guess, for lack of a better word, leveraged positions, outsized positions get taken out with this kind of a shakeup, as we've seen in the past as well. But does this in any way shake sentiment meaningfully, or you think it's going to be short-lived? Right now, since we're in the midst of it, it feels outsized, very large, but a day or two more, and unless the global picture sours, things are back on track. What's your sense?
Thanks, Prashant. It is fantastic. Thanks for having me here, first of all. And post-COVID scenario, when markets are running up for the last 1.5 years continuously, taking a breather is definitely was on cards in our mind. And looking at the valuations of various stocks and various sectors, we see that there is a significant amount of exuberance in many sectors at this point in time, especially global sectors, where it is linked to technology, it is linked to new tech. We think that the exuberance is unbelievable. So we are looking at some of the old economy sectors where it is looking very attractive at this point in time, and especially the fact that India Nifty earnings growth is picking up after a very long time. We see a huge opportunity investing in domestic cyclical sectors and including pharma. So we think that definitely the correction has to be meaningful. Maybe the sentiment change is going to be very, very material, and especially bull market corrections, as you know, Prashant, are going to be brutal and earth-shaking. So I seriously think this is maybe a start of a massive correction which can happen, looking at the exuberance in many sectors and stocks.
Oh, interesting view, George. You're sounding quite cautious this afternoon, but I want to focus on a bright spot. So to call it a bright spot, we have a lot of these stocks that are falling off the cliff today, but the Nifty Bank and the banking index is doing relatively better. One would think if the economy is going to recover, credit growth is going to pick up, and worst of asset quality is behind us, then that sector could look up. I'm looking at your portfolio, and you have a couple of these, quite a few of these mid-sized banks out there. What's your pecking order? Would you stick to the private banks? And would you prefer some of those mid rather than the frontline banks?
Yeah, so I think there is definitely, you have hit on the nail. Banking sector does well when the domestic cyclicals, domestic businesses starts improving. After a long time, we are seeing that Nifty earnings growth is picking up, and especially because of real estate picking up and various other domestic cyclical sectors picking up. As you rightly mentioned, most of the NPA problems which banks were facing, as well as the corporate balance sheets which were in trouble in the last 10 years, most of them being cleared out or in the verge of clearing out. We see a significant room for being overweight in banking sector stocks. Especially the mid and small cap stocks are looking within the banking sector, looking very, very attractive according to us. And that's where we have our bets, because most of them are available at throwaway price, and nobody is interested at this point in time. And as you would notice that your banking index has underperformed the broad market also in the recent rally. So we are quite bullish on the banking sector, and this is the first time in my career we are going overweight on banking sector, and I believe that there is more room and structural reforms which government has taken over a period of time all become tailwinds for the sector in the coming. So we are bullish on PSU banks, private banks, and across board, but mostly linked to the corporate banking sector reform recovery, which we are thinking that it will be material in the next many years to come.
Right. Got that. That is one space which I have to say is, banking, which got some comfort, valuation comfort, business-wise there is comfort, balance sheets are pretty clean. Growth, of course, is an issue, but that big risk of asset quality, etc. These have been tested over 2 quarters, actually not 2 quarters, for the last 1 year, 1.5 years. They raised capital. and as I said, valuations are not absolutely, out of whack. Housing finance companies like HDFC, George, if you want to weigh in, I'd put this out earlier, I think a month and a half back or so, just the divergence. Real estate stocks have done extremely well. Real estate sales in the organized space, unorganized space is also doing well. We track the organized space with listed players. But you look at something like an HDFC, which is the market leader in mortgages. It's not participated in any meaningful way. Would you look at mortgage finance players like HDFC?
Yeah, definitely yes. Real estate is doing well as you were mentioning. And we think that real estate is picking up meaningfully across cities. I've been traveling the last 20 days in various cities, and I can tell you that real estate prices are moving up and the demand is picking up massively, which is going to be the main fulcrum for the entire economic growth, which is picking up. Cement demand picks up, steel demand picks up, and then obviously when real estate demand picks up, the companies in housing finance also will be beneficiaries. But what has been happening during the Corona phase in the last 2 years is most of the people were going and repaying the loans because they didn't want to keep too much of debt in their balance sheet. So that's what would have impacted the growth of some of the housing finance companies which you were mentioning. And we believe that that phase is over, and you will see significant improvement in the growth phase, disbursement phase in the coming years, as the main sector which is in the limelight at this point in time is real estate, and which is going to materially change the entire course of the domestic business cycle improvements. Because construction activity picks up, being the largest employer, it will have a material impact on the GDP also. Second largest employer. I would say that real estate picking up is the biggest positive news I can think of. And at the verge of corporate profit to GDP, if you look at, which is at a 20-year low, and when you see the interest rate cycle bottoming out, real estate prices bottoming out, and also government finances well under control, and the significant infra push from the previous budget as well, you see that there is a significant room for surprise on the domestic economy front. And I'll be a big buyer on the India story rather than investing in some of the global stories.
George, you're sounding positive on the Indian recovery story, the economy recovery. You're seeming that you're tilted more towards value stocks rather than growth-oriented stocks, at least in the near term. And you're a little bit cautious on those stocks where valuations have really run up. I want to ask you about the consumption theme. In the last couple of days, we have had Nestle, you had Hindustan Unilever, the stocks that traded very hefty valuations. They came out with a set of numbers and those stocks have sold off. So what's your take on the consumption theme? I'm just looking at your portfolio and ITC finds a mention out there. Valuation-wise, there's comfort out there, but how would you approach the consumption theme?
Yeah, so if you look at in history, 1990 to 2000 was the period where TMT boom was there, technology, media, telecom boom. And if you had bought at the fag end of the technology boom, the technology stocks, even today you are underperforming the Sensex. In the next decade, we saw the infra boom. We saw massive recovery in the domestic economy-oriented sectors, be it capital goods, engineering, utilities, and corporate banks. And eventually, if you had the fag end of 2008 to 10 period, if you had bought any of these sectors, you would have lost big money in the last 10 years. The same way, last 10 years, it was consumer-centric boom. Consumer retail, consumer finance, and consumer staples have done exceedingly well. And the most of the price to earnings multiples of these companies have moved from 10p to 80p to 100p. And it is a matter of judgment that the investors need to have at this point in time. If you're investing into these sectors at these valuations, you are tend to underperform the Sensex meaningfully in the next decade. So we are quite careful about valuation. Our investment philosophy is very simple. Buy good quality stocks at attractive valuations, and companies where there is no leverage. Some of the names which you mentioned, where the valuation comfort is there, probably it will figure in our portfolio. But where the valuation comfort is not there, we are completely out of the entire consumption theme.
Okay.
So consumer goods is a case in point where we like a lot, because discretionary consumption will increase as the real estate demand picks up.
Yes.
We are going to see that consumer goods companies can do exceedingly well. And last 4 to 5 years, many stocks have moved in terms of valuation or the price points.
Okay. Good quality companies at decent valuations. We get that point, George. Thanks so much for joining in. I would like to say that maybe you were a good luck charm for the markets today because we haven't fallen any more, at least. We've seen a bit of recovery from the low point of the day. Good chat with you today.
Thank you. Thank you so much.
Well, on that note, though, we'll have to slip into a short break. You come back, we'll try